Hi, Armando Rahman here with AXIOM Founders Family Office with Warren Taryle, tax strategist extraordinaire with Tartle County here in Scottsdale, Arizona. Uh, Warren, this conversation today, first of all, thank you so much for the time this afternoon to talk with you. People are hearing about this new tax bill that came out in July of 2025. People don't really know what it means. A lot of things still have to be understood about it. And I'm sure you're still learning about it, and the IRS is defining what different terms mean. But as you think about this tax bill that's come out, what is your gut? What is your thought for that business owner who now has this new tax bill available to help them with their business?
Sure. Well, thanks, Armando. Glad to be here with you. And you brought up the right point, is that we're still waiting for a lot of guidance from the IRS because, as you can imagine, there's a lot of details in all of this stuff. And just one little funny thing that just happened, you might have just heard it, right? So we are now going on to our seventh IRS commissioner since January. Uh, our last IRS commissioner just got reassigned. I don't know that this is actually a promotion, but Trump has moved him from IRS commissioner to ambassador to Iceland. So, and all this happened right after he had mentioned he was in front of a bunch of tax professionals at the National Tax Conference, and he had mentioned that filing season would begin after President's Day, which is in February, when normally filing season starts in January. And he was alluding to how long it's going to take the IRS to digest all these changes that are effective for 2025. Well, apparently that wasn't the right answer because he's off to Iceland. And the last thing he did say before he got shipped off to Iceland is said filing season will begin in January as usual.
Oh, it sounds like the Russians sending someone to Siberia.
Right. So, anyway, so I'm said all that just to say we'll talk in some generalities. The tax law was passed, but it's once the IRS tells us what it means, that's what it means. Whether that's a good thing or not, we still have to go by what the IRS rules are, unless anybody wants to have a court case named after them.
Yeah, yeah, and I'm sure nobody really does. So in general, given that things still have to be, the details still have to be ironed out and forms and all that, in general, as you've read through the tax bill and you think about your clients who own businesses, who started great companies, they're growing them and having profits and taxes, your gut tells you that this is good for them or not.
This is good. There are a couple little pitfalls along the way. Most of it is, on the individual side, but a lot of business owners and individual, those things overlap a lot anyway.
Yeah.
First, let's start in generalities, right? The main thing this bill did was made the TCJA, we love our initials, right? So Tax Cuts Jobs Act, I believe that's what it was called,
Yeah.
uh, act permanent. Most of the matters permanent, including, and this is a big one, some things on the estate tax, right? So uh, I was telling you, my mom called me one day and left me a message. She was all excited. I heard the estate tax got repealed, and and no, it didn't get repealed, but they set the exemption to 15 permanent now to 15
Yeah.
million dollars, and it's going to be indexed for inflation going forward.
Yeah.
So when I called my mom to tell her that it was $15 million, I was really hoping for her to say "darn," but she said, "Oh, good." Which
Yeah, and let me just touch on the TCJA. What that refers to, Warren, for those who don't know what that acronym really means or what it was, all of the tax laws were supposed to change January of 2026. They were going to go back down to the lower numbers, right?
right.
But instead of expiring like they were going to, this made them permanent. So there is no expiration in January 2026, correct?
Correct. Except for a couple of things. I'll mention those in a second. And so that's for the the most of the TCJA Act got made permanent. Now there are new things that also got introduced aside from making those changes permanent. The new things that they added, most all of them go away in 2028. So we didn't get rid of things going away. We didn't make everything permanent. The new stuff is now only till 2028 for the most part.
Okay.
So anything new that we talk about, no, that's going to have a deadline. Most of that starts, most of the new things actually might not even start till 2026. So we can, as we go through, we can talk about when things start.
Okay.
Uh, the TCJA was originally, they did it as, they called it tax simplification. And remember, they were trying to get us down to a postcard sized tax return. This bill is the exact opposite. There are so many phase outs and start dates and end dates, and yeah, they and above the line, there's just all kinds of stuff. The tax return is now getting thicker,
Hmm.
uh, as we all kind of suspected it would.
Okay. So if you, why don't we start, if that's okay, with bonus depreciation? When you and I got together recently, that seemed like a pretty big deal for the business owner. Maybe you just touch on that, please.
Right. So and for us, that was the most exciting part. And that's something that was left started in TCJA. So bonus depreciation, they keep calling it in the news and the president talks about it and they call it expensing, business expensing. So basically, when you buy property, plant, or equipment, the hard things, we all know that as business owners, the assets, we're supposed to depreciate those over their useful life.
Yep.
5 years, 7 years, 15 years, 27 and a half, 39. So there's all these lifetimes. Well, bonus depreciation came around and said anything with a life of 25 years or less, you can write off 100% of immediately.
Wow.
So we don't have to depreciate those things. We get to, as they're calling it, expense those now. Uh, that started to phase out a couple of years ago, and it was supposed to be gone by the end of this year. Uh, and for 2025, we were down to 30%. Instead of writing it off 100%, we can only write it off at 30%, which was still not a bad thing.
Yeah.
But now, since the one big beautiful bill, well, there's a debate as to what we're going to call that thing because nobody likes calling it the one big beautiful bill. It's actually one big beautiful bill act.
Act, right.
Uh, but uh, I like triple B.
Yeah, OBBA. So,
But so this now has made the 100% expensing or bonus depreciation permanent, and it's retroactive to January 20th, so inauguration day, basically.
wow.
So
Okay.
so if you put any assets and services, this is a little strategy. You might have bought some major equipment or purchases or property or something like that. And we can get into the detail of that in a second. You might have bought those the first couple weeks of January. We're going to not put those into service until after January 20th. And that's really the IRS standard. When you're supposed to start deducting things, when you're supposed to start depreciating things, is not necessarily when you purchased it, but when you began using it for the business purpose. And
Right.
so we want
So,
to be really careful. It's going to cost you 70% if you put it in service January 2nd as opposed to January 20th.
yeah. So an example might be you bought a new Ford truck that cost you $100,000. You bought it on January 10th, but didn't begin to use it for work until January 21st. That's placed in
Exactly.
service.
Exactly. You did some leasehold improvements, you bought a new
Yep.
machine, or, and this is where the big part of bonus depreciation comes in from is rental properties and doing a segregation study where we're able to break out chunks of those buildings that we're using for either commercial rentals or personal rent or residential rentals and write off big chunks of that purchase. Usually, usually we'll see, this is just some really round numbers, but usually we'll see when you have a cost segregation study done, and I know we're talking jargon here, so I apologize for that, but you buy a rental property and we could go in and break out what you actually bought. So in that rental property, the normal depreciation will say we depreciated over 27 and a half years.
Yep.
But when you bought that building, you bought more than just the building itself. You bought a lot of personal property, things that can be removed without causing damage. Things like appliances and cabinets and countertops and window treatments, all these things.
Yep.
And those things can be depreciated much quicker. And all of those things now qualify under the bonus depreciation rules, meaning you can write those things off. Long story short, basically 20 to 30% of the purchase price we find often people can get in bonus depreciation. So you bought a $100,000 building, residential rental building, then generally we'll see 20 to $30,000 immediate deduction for those items.
Yeah, and let me clarify something you said earlier. You said that the bonus depreciation, anything that is 25 years or less in what's called useful life,
Right.
that is what bonus depreciation applies to. But with with residential real estate, many people buy a single family home or a condo to rent it out, and that's residential real estate. That useful life is 27, is it 27 and a half years?
27 and a half years.
Yeah, so
so
that's a great example. That is, of course, more than 25, so you cannot use bonus depreciation on it. But what you just said is, if you do a cost segregation study on that property, you can pull out those things that have a useful life of under 25 years and write those off 100%.
Right. And that's going to be extremely important as we carry on this conversation.
Exactly. Yep, exactly.
There's also a new category carve out, and this comes under the new rules. So this expires in 2028.
Okay.
And but it's for non-residential properties that are used. I've got my notes here. Non-residential properties that are used in manufacturing, agriculture, chemical manufacturing, and certain kinds of refining. So
Okay.
buildings, the entire building in this case, and those would normally be 39-year depreciation schedules. So this is a big exception to the rules. Any of those things can now qualify as 100% bonus depreciation, the entire building. You spend $30 million on a new manufacturing building, just even the building itself, you get a $30 million deduction on day one.
Wow, I didn't realize that the whole thing in the year that you buy it and place it in service.
Well, now it's not buy it. So remember, the purpose of this law is to try to bring manufacturing to the United States. So they want to see new stuff. So you're going to have to construct this building. So
Hmm.
somebody who, you want to build a manufacturing plant or whatever. So it's construction that begins after 1/19 of 2025, but before 1/1 of 29.
Okay.
You start manufacturing, and then it needs to be placed in service after July 4th of 2025, when the bill was signed, and then but before 1/1 of 29. You get the 100% bonus depreciation, the entire building. Now, what we don't have clarification on, what I haven't found anyways, is does this have to be for self-use? So if you have a manufacturing company and you build your own manufacturing facility, or can you just be a landlord, build a new warehouse building or a new refinery or something, and lease that to somebody else? That will get guidance on, hopefully very quickly, but that again is really, really big.
So yeah, I can see how that would encourage new construction. And you say within certain classes like manufacturing, agriculture, chemical, something, and refining, it's within certain types of industries.
Right. It's all back to bringing manufacturing back to the United States.
Okay. And if interest rates go down as we think they will between now and year end, that's going to help as well. Lower
Oh,
interest
definitely.
finance things. Wow. Okay. Well, that's pretty big. Well, that's pretty darned amazing. And we've talked a little bit about cost segregation studies. And just so that the listener is clear on what that means is a cost segregation study, as I understand it, is where you have somebody come in and they take a look at that building and they have to pull apart the pieces like the electrical, the plumbing, the AC unit, the water heater. They break that building into its component parts. And then the parts that don't live the whole life of the structure itself, they assign a shorter useful life, and that's what can be written off much faster than the typical life of the building itself,
Right.
right?
Right. Under the general rule, you pay an amount for a building. and we consider that all building. Uh, but there's been some court cases way back when, before I even started accounting, that the courts basically said if you can come up with the value of those individual components, you can list them individually and not just make it the whole building. So this cost segregation study people come in and basically say you paid $1 million for this building. They'll go in and look at all the components and determine out of that $1 million, how much of it went to these 5-year property, the 7-year property, the different life properties based on what they are.
Yeah.
Land improvements. That's when some people forget about things on the outside of the building. Land improvements have a 15-year life, so they qualify as bonus depreciation. And land improvements is anything you do to the outside, especially if a commercial type building, so it's gonna be the parking lots, sidewalks, driveways,
Yeah.
fences,
Signage.
landscaping, irrigation, all of that stuff. We can get bonus depreciation on it.
Wow. Yeah. And I spoke with a cost segregation study company just a couple of months ago, and the cost segregation study was not as expensive as I thought it would be. It was somewhere maybe $5,000 to $10,000, which is granted, yeah, that's a chunk of money. But if you can pay a cost segregator to do that study for you and flush through the expenses on that building 10 times faster than you normally would have,
Right.
it pays for itself by the tax savings that year alone.
Right. And that's a big study. I mean, people who are getting, single family homes that are going to be a rental property, I've seen studies as low as $600 to $1,000. So
Wow.
it really depends on how much work they're having to do to get that study done. A lot of the companies, this is one of the things I really like, is a lot of the companies do what they call computer models, and they do these for free. So you give them some basic information about a property, and they will give you an estimate of what they think they're going to find, and also give you the cost of what it's going to cost them to do it, so you can make a decision if it makes sense or not
Mm.
before you spend the money.
Yeah, definitely worth looking into. Fantastic. And what about, 1031 exchange has been around for a very, very long time. And the basic idea is when you sell, for example, the most common uses I've seen for 1031 exchanges is somebody selling a piece of real estate, either a single family home rental or a commercial building. So you can buy something, lease it out for a number of years, sell it. And if you sell it following all the rules that a 1031 exchange requires, there are these specific number of days windows that you have to identify a replacement property and actually buy that replacement property. But if you follow all those rules, 100% of the gain can be deferred until later, meaning not paid today, pay it later when you resell that property later. But I'd like you to, if you could, Warren, talk about the 1031 exchange. Now that we have all this bonus depreciation available to us that didn't exist just a couple of months ago, how do you see that 1031 exchange being used going forward?
I mean, for the most part, except for some really unique circumstances, I'll say this, probably 1031 exchanges are a thing of the past.
Hmm.
They're not necessary except in some very unique situations. And let's go through it. And that's a big statement for you to make, because it used to be 1031 exchange was kind of almost the automatic knee-jerk reaction. Like, I'm selling a property at a large gain. I'm not getting out of real estate. I want to buy some more stuff. I'll do a 1031 exchange
Right.
and kick the can down the road a few more years. But that's not the go-to answer anymore. That's not default. It's now we got to really look at and run the numbers. You're working with a tax professional, you need to don't just decide to do that, and don't let them just tell you to do it without giving them some information, because those numbers really need to be run. First off, let's go back to some basic rules with rental real estate. The income and loss from rental real estate is considered passive. And we have passive loss limitation rules, meaning if you have passive losses exceeding any type of passive income, there's some hoops we have to jump through before you can deduct those losses. And there's a lot of people who have rental properties out there that haven't been able to deduct all of the losses they've been accumulating over the years. And
Hmm.
those losses just keep growing every year. They keep rolling forward and we keep adding to them. According to the general rule, those losses free up and you get to deduct them against ordinary income the year you sell whatever created that loss.
Yeah.
And if you do a 1031 exchange, that's not considered a sale. So those losses just roll into your new property. So we don't get to ever tap into those losses that we've been paying for and accumulating all those years. So just looking at how much loss you might have the ability to take by selling, that could right there tell you we don't need to do a 1031 exchange. But let's go beyond that. And this gets a little bit complicated. But so in a 1031 exchange, you need to take all of the money, all of the proceeds from that property that you sold and put it into a new property and finance that new property at least as much as the old property was financed. So you're putting every penny in, and
Yeah.
usually you're stepping up. Think of it as monopoly, trading houses for hotels
Yeah.
is what we're doing. So you're already planning on spending the money on a property. Now, if you took all that money and rolled it into some other properties and we did the cost segregation study on it and used the bonus depreciation numbers on it, you'd be surprised at how big a one-time write-off we can end up with that could very easily offset all, if most, if not all, of the gain that you're going to earn on the other property. So it's not an automatic thing. Now here's one of the things that makes it more complicated, right? As you guys know, because we just mentioned it, and some of you are probably thinking it, that well, if I write off all that depreciation, that just is another passive loss, and I won't be able to use that passive loss until I sell my other sell that property, and that's true. But here's the part, and I have a difficult time explaining this to people, so you can be patient with me here. So when you sell a rental property or sell anything that generated passive income, that sale, the profit from that sale is considered passive income for the purposes of offsetting passive losses. You still get long-term capital gains treatment, so you get that lower tax bracket, but it also will free up a corresponding amount of losses that you haven't been able to use. So if you sold, let's just use very simple numbers, you sold a rental property for $100,000 profit, and you bought another rental property, and let's say we got $100,000 loss, let's say $150,000 loss in the new rental property. If you do it all within the same year, we'll look at that and say, well, he's got $100,000 passive income, $150,000 passive loss. We'll wipe out all that $100,000 income and still have $50,000 rolling forward to next year. So we get to free up $100,000 of passive losses. Those passive losses free up and you can use them against ordinary income. Ordinary income's taxed at the highest possible tax bracket.
Yeah.
Tax brackets for you, right? The gain when you sell that property, that $100,000 gain that you're going to pay taxes on, that gain is taxed at long-term capital gains rates, which is substantially lower than the ordinary rate. So in this case, we freed up $100,000 of losses. It more than offsets $100,000 of the gain income, because the gain income's taxed lower. The losses are taxed higher, if that makes any sense.
Yeah, no, I'm following along with you. I think that maybe folks who are not familiar with some of this terminology or haven't gone through this before, I think the takeaway for them would be, hey, right now, as you and I sit and have this conversation, this is the middle of August. If they are going to sell something in the next month or two, they've got to get with you or a tax practitioner who can run these numbers for them, especially if they're thinking they're going to buy another property with that money before year end,
Right.
because there's a window where they can offset the gain against other losses. Or if they don't buy that replacement property until January, which is the next tax year, they may have missed the window for this tax year on offsetting that gain, right?
And yes, and possibly even worse. So if you bought that, if you sell your property this year, 2025, buy new property in any time in 2026, now you have a passive loss, and we can't count that gain that you earned in 2025 as passive income to offset the passive loss you have in 2026. So we might have just created a loss that's going to sit there quite a while.
Yeah. So it
There are some
really,
ways to deduct real estate losses, and that's beyond the scope of what we'll get into right now, being a real estate professional or not. But what I'm talking about, you don't need to be a real estate professional. You don't need to jump through all the hoops to deduct passive losses, so long as you buy and sell the property within the same tax year, and that's crucial. If you can't buy the replacement property by the end of the year, let's say your sale goes through in December, uh, then maybe you do need to stick with the 1031 exchange, because that will help bridge into the next year. Now, the other thing, and if you have the cash to do this, right, we can get it in the other order. You can buy a property right now and sell your property in December. You can get one before the other, so long as you can swing it cash wise.
yeah.
It just needs to both happen within the same year.
Yeah. And the year for individual taxpayers for us people is December 31. That's the end of the year, right?
Right. Right.
Yes, it's got to get done within the 12 months that end on December 31st to really maximize the benefit for the person who's buying and selling that piece of real estate.
Yeah.
Yep. Okay, good. And let me just, if we can just touch on buying American-made vehicles. I know we talked about that also recently. I don't know how clear that is yet with the rules and all. Can you touch on that, please?
Yeah, it's getting clear. First of all, the one of the downsides, if you would, of the new of the OBBBA, yeah, got enough B's in there.
Three Bs.
Uh, then is the clean vehicle tax credit, the credit for buying electric vehicles and all that, that goes away. And it goes away this date, you got to keep in mind. If that's an idea that any of you have, that credit expires on September 30th of this year. So you have till September 30th to buy an electric vehicle and still get whatever credits are available for it.
Okay.
Uh, so that goes away. Solar for your house, just so you know, that goes away December 25th. So you have to the end of December. So you have till the end of December this year to do solar for your house and get that 30% credit. Uh, but but buying a new car, so it has to be a new car, but if it's an American car, you can deduct the interest up to, I believe, $10,000. Yeah, $10,000 above the line deduction for buying a new American car. Now, American car is defined as the final assembly taking place in the US. So people said, well, oh, so I can't buy a BMW? No, there's a lot of BMWs that have final assembly in the United States.
Yeah.
So the interest, so we're just talking about the interest, and I'm looking for my notes on it really quick. The deduction started this year. So any car purchase from from again, the beginning of all these things, 1/19/2025, it expires in 2028. Up to $10,000 of interest. There is a phase out. Remember, I said this made life gets more complicated. So the $10,000 deduction starts to phase out for a single person of income over 100,000, married $200,000. We start to phase out that $10,000 interest deduction.
Okay.
In order to do it, you're going to need to report the VIN number on the tax return, and the lenders, this is just for the lenders, are going to start having to issue you a statement, kind of like maybe even though it might even use the 1098 forms that they use for mortgage interest. you'll
Okay.
get one now for your car interest.
Hmm.
So that's how the IRS will tie it all out.
Wow. Okay.
But it was significant enough that my wife, who hates American cars, started thinking, hey, we rented we went somewhere, we rented a new Jeep to drive around, and she kind of liked it. And she said, and I was so proud of her because she thought, hey, doesn't this qualify for the interest deduction? Like, hey, that's pretty smart of you. So,
You didn't tell about the BMWs made in North
no,
Carolina?
no, no, we're sick with the Jeep. Also, throw one more thing as a little, it's also something that we need to think about this year because there's some changes, not necessarily for the better next year, I think, in charitable contributions.
Okay.
So in charitable contributions, some good and some bad. And so it really depends on where you are on this line. So as we all know, if you itemize, you don't take the standard deduction, but you itemize, you can deduct charitable contributions as an
Mm.
itemized deduction. Well, since they've increased the standard deduction so much over the, well, the TC Tax Cuts and Jobs Act raised the standard deduction so high, there was a lot of people who just don't itemize anymore, and charities were feeling the pinch. And so now, beginning this year, 2025, if you don't itemize, you can take what they call an above the line deduction, means you can take the standard deduction and the charitable deduction up to $1,000 for an individual, $2,000 if you're married. Now,
Wow.
so thinking about charitable, before you get to the end of the year, think about this. Then part two of that is if you do itemize, beginning in 2026, they're going to have a 0.5, a 0.5% of AGI floor for your charitable deductions. So that means, let's say you have a $100,000 AGI, adjusted gross income, sorry. Then what's that come to? $5,000 floor on charitable deductions. So your first $5,000 of charitable deductions won't be deductible. It's only when you exceed that floor can you start taking deductions. So if you are an itemizer and you normally make large charitable contributions, you might consider accelerating your charitable contributions this year before December 25th, because beginning 2026, so I keep saying December 25th, but I mean December 2025. So get your deductions in this year. Beginning 2026, you're going to take a haircut on the amount you can contribute charitable deduction wise. And then we might want to shift into, I thought I lost you for a second.
Hey, we're still here.
Okay, my screen just went out, but I'll trust we're still here. So in 2026, we might want to start phasing into something we've done a lot before, where if you are a big contributor, maybe consider contributing every other year. So
To bunch them up.
bunch them up so that you only have one haircut, one floor to overcome.
Yeah, yeah. And there are tools like a donor advice fund, which can be a great tool for that bunching up of
Yeah,
contributions.
this is a big donor advice from plug. Even the tax strategy conferences are talking about that these things are going to become more and more valuable now.
Wow. Okay, fantastic. Warren, thank you so much for this time. Really appreciate it that you're sharing your expertise with folks. I realize, of course, there are still more details to come from IRS. But as you said, these due dates are very, very specific and expiration dates very specific. So it just drills home to people, to the listener, that they've got to get with their tax person, say with you or their own tax person, to have the conversation now before the end of the year while they can take some action to help themselves.
And if you want to contact us, I made a special website or a special link to our website so it's easier to remember. Right? These things are hard to remember when you're just listening, but it's OBBBA tax.com. So one big beautiful bill act tax.com.
Okay.
And
Thank
that'll
you.
link right to our to our website.
Okay. Fantastic. Warren, thank you so much. Really appreciate the conversation.
All right. Thanks, Armando. It was
All
great
righty.
talking.
Nice talking
Bye.
with you.